All right, annuities. They're a big part of retirement planning, but to be honest, they can be kind of confusing.
Yeah, I agree with you there. It's like a whole different language sometimes. And that's why we're doing this deep dive today. We want to break down annuities, figure out what they are, how they work, and really whether or not they make sense for your retirement plan.
And we've got some great experts with us for this.
We
So
do.
we're partnering with the folks over at Diversified Insurance Brokers. Okay, let's start with the basics. What is an annuity?
Yeah, it's not a term you hear every day, right?
Not really.
Um, the simplest way to think of it is it's like you give a lump sum of money to an insurance company, right? And in exchange, they promise to give you a stream of income, often like for the rest of your life.
Okay, so it's like you're building your own personal pension then.
Exactly. That's a great way to think about it, like a personalized pension plan.
Makes sense. But then there are all these different types of annuities, right? Fixed, indexed, variable. How are they different?
Yeah, it can get a little confusing. Let's start with the easiest one, a fixed annuity.
Okay.
So that's the most straightforward. You get a guaranteed interest rate, and your money grows steadily over time, like predictably. No big surprises.
So it's like a really, really good CD.
Yeah, think of it like a supercharged CD.
Okay, but if it's predictable, does that mean the returns are lower?
That is a great question. And you're right, predictability, it does come with a little bit of a trade-off.
Right.
So while your money is safe and growing steadily, the returns might be lower compared to, if you were investing in something riskier. It's a balancing act.
Yeah.
Security versus like shooting for the moon kind of thing.
Okay. All right, that makes sense. Now, what about indexed annuities? Those seem to be pretty popular right now.
They're gaining a lot of traction, and it's for good reason. So indexed annuities are a little bit more adventurous, I guess you could say. Your returns are actually linked to how well a particular market index does, like, the S&P 500 is a common one.
Right.
But, and this is the important part, there are these things called caps and floors built into them. The cap limits how much you can earn, but the floor protects you from losing money if the market crashes.
Wait, so you can still lose money with an indexed annuity? I thought there was a floor.
Oh, no, you won't lose your original investment.
Okay.
That's what the floor is for. But what could happen is your gains might be limited because of the cap. If the market like explodes and grows a ton, you might not get all of that growth because the cap kind of puts a limit on it.
I see. So like if the index goes up 10%, but the cap is like 7%, you only get the 7%?
Exactly. That's exactly how it works.
Okay. And who determines that cap?
So the cap is it's set by the insurance company, and it depends on a few things, like what's going on in the market at the time, what specific index is being used. It can also be influenced by the fees associated with the annuity. So, if it's got a lower cap, it might mean lower fees. It's a trade-off.
Okay, so you really got to like shop around and see what the different options are.
Definitely. Understanding that cap and floor is really important when you're looking at different indexed annuities.
All right, that makes sense. And then last but not least, the more complex one, variable annuities.
Yeah, those are the ones where things can get a little more intricate. So variable annuities, they work a lot like investing in mutual funds.
Okay.
But it's within the annuity. So you choose from a bunch of different investment options, and then your returns, and this is important, your potential losses depend directly on how well those investments do.
So it's almost like having a 401k, but with these extra annuity benefits.
You can think of it that way. You get more control over your investments with a variable annuity. You're aiming for those higher returns, but you also take on more risk, just like you would if you were investing in the stock market directly.
Oh, okay. So you could actually lose money with a variable annuity.
That's right. It's not like a fixed annuity where your principal is guaranteed.
Yeah.
With a variable annuity, the value can go up and down depending on the market.
So how do you decide if that risk is worth it?
That's the million-dollar question. It really depends on your individual circumstances. Your risk tolerance, how long you have until you retire, what your overall financial goals are. Generally speaking, variable annuities are probably better suited for people who are younger, have a longer time horizon, and are a little more comfortable with, taking some risk to try and get those higher returns.
So it's all about like matching your risk tolerance with what you're hoping to get out of it.
Exactly.
Okay. All right. That's a great overview of the different types of annuities, and I think we've covered a lot of ground. So why don't we take a quick break and then come back and dive a little deeper into some of the nuances of each type and when they might be a good fit for you.
All right, welcome back to our deep dive all about annuities. I feel like we've already covered a lot, but I'm sure there's still more to unpack here.
There is. We've talked about, what they are, the main type.
Right, the basics.
But now let's get into some of those nitty-gritty questions that you might have if you're actually thinking about getting an annuity.
Right, like how do you actually get one? It's not like you just, click buy now on Amazon.
No, definitely not. the first step is really finding a good financial advisor or insurance agent, someone who specializes in annuities.
Okay.
They can really help you, figure out what your needs are, which type of annuity might be the right fit for you, all of that. Okay, so you need an expert in your corner. Got it. But how do you know who to trust? There's so many insurance companies out there. It can be hard to know where to even start.
It can. And that's why it's so important to do your research. Look for companies that have a good track record, good customer service, and then check those independent ratings agencies like AM Best or Standard& and Poor's.
Right.
See what they have to say about the company's financial strength. This is a big chunk of your savings we're talking about here. So you want to make sure that you're working with a company that's solid, that's reputable.
Absolutely. So you found a good advisor, you found a good company. What are some like red flags? What should people watch out for before they sign on the dotted line?
Oh, that's a great question. I think the biggest red flag is if something sounds too good to be true, it probably is.
Right.
If someone's promising you like guaranteed 20% returns, walk away.
Yeah.
Annuities they're about slow and steady growth. They're not get rich quick schemes. Another thing to watch out for are the fees. Those can vary a lot from one annuity to the next, so make sure you understand exactly what you're paying for. Compare the different options.
Don't be afraid to ask questions.
Exactly. And if something feels too complex or like you just don't understand it, don't let anyone pressure you into signing anything. Your advisor should be able to explain everything to you clearly and answer all your questions, in a way that you can understand.
Okay, transparency is key. Got it. So what about like the opposite? What are some green flags that suggest an annuity might actually be a good fit for someone?
Well, first and foremost, like we were talking about before, feeling good about that insurance company's financial strength, that's huge.
Yep.
And then having a clear fee structure, knowing exactly what you're paying for, no hidden surprises there. And then, most importantly, I think making sure that the annuity actually aligns with your goals, with your risk tolerance. If you're close to retirement and you're looking for guaranteed income, a fixed annuity might be a great option. But if you're, younger and you're okay with taking on a little bit more risk, maybe an indexed annuity or a variable annuity would be a better fit.
Yeah, it's like finding the right tool for the job?
Exactly.
Okay, so we've talked about the red flags, we've talked about the green flags, but I got to be honest, annuities aren't really like the most exciting topic, right? How do we make them less boring? What's the fun part of annuities?
I think the fun part is it's about shifting the perspective, right?
Okay.
Instead of focusing on all those technical details and numbers, think about what those numbers can actually do for you.
Okay.
It's about security, it's about stability, it's about peace of mind. Annuities, they're really all about knowing that you're going to have money coming in to cover your expenses, no matter what's happening in the market or how long you live.
So it's not just about the numbers, it's about the lifestyle you can have with those numbers.
Exactly. Imagine this. You're retired, you're traveling, you're spending time with your family, you're doing all the things that you've always wanted to do, and you don't have to stress about money. That's the power of an annuity.
I like that. So maybe we need to be telling more stories about, how annuities have helped people achieve their goals, like achieve their dream retirements.
I think that's a great idea. Put a human face on it. Show how annuities can actually help people live their best lives.
Okay, all right. Well, on that note, let's dive back into the different types of annuities. I'm sure people want to hear a little bit more about those indexed annuities, about those variable annuities. Those are the ones that have the potential for that higher growth. Let's start back at the beginning. Let's talk about fixed annuities again.
Okay, yeah,
I think it's good to have that foundation.
definitely.
So those are the ones that are like guaranteed interest rates, right? Good for people who aren't comfortable with a lot of risk, who want something predictable.
Right, exactly. You give the insurance company a chunk of money, they guarantee you a specific interest rate, and then your money just grows steadily over time. Pretty straightforward.
Okay. But what happens at the end of that guaranteed period? Like, is that it? Do you just get your money back?
That's a good question. You actually have options at that point. You could take all your money back in one lump sum, or you could choose to convert it into like regular payments, kind of like getting a pension.
Oh, okay. So you can either cash out or you can create that guaranteed income stream.
Exactly.
Interesting. But with interest rates being so low right now, I mean, why would anyone choose a fixed annuity? Wouldn't they be better off like investing in something else?
Well, interest rates go up and down. And what a fixed annuity does is it lets you lock in a rate. So if you're someone who's like really worried about what's going on in the market, they're worried that interest rates might go up in the future, a fixed annuity can actually provide a lot of peace of mind.
So it's kind of like a hedge against future uncertainty.
Exactly. You know exactly what you're getting.
Got it. Okay. All right, well, let's move on to indexed annuities then. Those seem to be kind of like the Goldilocks option.
Yeah, I like that.
A little bit of risk, but also, a little more potential for growth.
They are, and that's why they're so popular. So with an indexed annuity, your returns, they're tied to how well a specific market index does. So like if you choose an annuity that's linked to the S&P 500 and the S&P 500 has a good year, your annuity value is going to go up too.
Okay, but it's not a direct investment in the stock market, right?
Right, there's that layer of protection, remember?
Right, the caps and floors.
Exactly. The cap limits how much you can earn, but the floor, that protects you from losing money, if the index drops.
Right, so you get like some of that upside potential, but with a safety net.
Exactly.
Got it. But how do you choose which index to like link your annuity to? There are so many.
So many. And that's a good question. And that's really where working with a knowledgeable advisor can be so helpful. They can kind of walk you through the different indices that are available, explain their historical performance, and then help you choose one that makes sense for you, that aligns with your risk tolerance and your goals. Some popular ones are, the S&P 500, there's the NASDAQ 100, and then, there are some international indices too.
Wow. It's like choosing your own adventure but with your retirement savings.
I like that.
Okay. But how do those caps and floors actually work? Like, can you give me an example?
Sure. Yeah. So let's say you choose an indexed annuity that's linked to the S&P 500, right?
Okay.
And let's say it has a cap of 8%.
Okay.
So if in a given year the S&P 500 goes up 10%, your annuity is only going to grow by 8%. So that cap, it acts like a ceiling.
Oh, I see.
It protects the insurance company from having to pay out too much.
So it's like a speed limit on your earnings.
I like that. That's a good way to think about it.
Okay. What about the floor? How does that work?
Okay, so the floor is your safety net.
Right.
So let's say your annuity has a floor of 0%.
Okay.
And the S&P 500 actually goes down, drops by 5%. You're not going to lose any money. Your principal's protected.
Okay.
The floor makes sure that even if the market goes down, you're not going to lose what you put in.
So that peace of mind is pretty valuable, especially if you're getting closer to retirement.
It is.
Okay. All right. So we've talked about fixed annuities. We've talked about indexed annuities. Let's talk about variable annuities then. Those are the ones that have like the most risk, right?
They do.
But they also have the highest potential for growth.
Right, exactly. They're definitely a different beat altogether.
Okay.
With variable annuities, it's more like you're actually investing in mutual funds,
Okay.
but it's all within this annuity wrapper. So you get to choose from all these different investment options. And then your returns and your potential losses, they directly reflect how well those investments do.
So it's like you're basically taking on the same level of risk as you would if you were just investing in the stock market yourself, but you're getting those added annuity benefits.
You got it.
Okay.
So the upside is you have the potential to earn a lot more if the market does well.
Right.
But the downside is you could actually lose money if your investments don't perform well.
So it seems like variable annuities are probably a better fit for people who are like further away from retirement. Is that accurate?
Yeah, I would say so. Younger investors, they have a longer time horizon. They can ride out those market fluctuations,
Right.
and they have more time to potentially benefit from the growth. But if you're someone who's like right on the verge of retirement, the risk associated with a variable annuity might just be too much.
So you're essentially making a bet on how the market's going to do in the future with a variable annuity.
You are. You're hoping that you can outperform those safer, more predictable options,
Right.
like the fixed annuities and the indexed annuities.
Okay, got it. All right. Well, I think this has been incredibly insightful. But before we jump into the last part of this deep dive, I want to touch on something that I know a lot of people think about, but it can be a little bit of a sensitive topic. What happens to an annuity when you pass away?
Yeah, no, that's a really important question, and it's something that everyone should think about. You want to make sure that, your loved ones are protected, that your assets are going to where you want them to go. And with annuities, it really depends on what's in your contract.
So there's not one simple answer.
Not really. There are different options. So one option is to get something called a death benefit rider.
Okay.
And what that does is it guarantees that any money that's left in the annuity, when you pass away, it goes to your beneficiaries.
Okay, so it's like having built-in life insurance almost.
In a way, yeah.
Okay.
Now, with those immediate annuities, the ones where the payments start right away, things could be a little bit different.
Okay.
Those payments, they might stop when you pass away. Unless you've chosen a specific option, like a joint life annuity that would cover both you and your spouse, or a period certain annuity where the payments continue for a set number of years, regardless of whether or not you're still living.
Oh, okay. So there are ways to make sure that the income stream continues even after you're gone.
Exactly. And then with those non-qualified annuities that we talked about earlier, your beneficiaries, they might be able to use something called a stretch strategy, where they can actually spread out those payments over their own lifetimes. And that could potentially help reduce their tax burden.
Oh, okay. So lots of different scenarios, lots of different options to think about depending on the type of annuity you have and what your contract says.
It really is about customization. It's about, finding the right fit for your needs, for your goals. And that's why it's so important to work with an advisor. They can help you navigate all of this and make sure that your annuity is structured in a way that makes sense for you.
Well, I feel like we've covered so much in these last two parts, the types of annuities, the pros and cons, red flags, green flags, what happens when you pass away, all sorts of things.
We have.
But I'm sure people are eager to hear more.
There's always more to learn. I think in the next part we can delve into some even more specific nuances. We can talk about how annuities compare to some other retirement options, and really talk about how to integrate them into a comprehensive financial plan.
Okay. All right. Well, sounds like we have a lot to cover in that last part. Welcome back to our deep dive on annuities. We've covered a lot of ground in the last two parts.
We have.
So now I'm wondering, how do annuities actually fit in with all those other retirement options that people have, like 401ks, IRAs, that kind of thing?
Right, right. Well, think of it this way. Those other accounts, the 401ks and IRAs, they're really your growth engine. That's where you put your money to try and, get those long-term gains.
Right.
But annuities, they're different. Annuities are more about creating that income stream.
So it's not about replacing those other accounts. It's about having them all work together.
Exactly. It's about diversification, right? Having different tools in your retirement toolkit.
Okay, that makes sense. So is it fair to say then that annuities can actually help reduce some of the risk that comes with those other types of retirement accounts?
Absolutely. Yeah. With a 401k, for example, how much money you have when you retire, it really depends on how the market's doing.
Right, right.
But with an annuity, you've got that guaranteed income. So it's less about, hoping the market does well and more about knowing that you're going to have money coming in regardless.
Okay. That makes me feel better already. But one of the things that I hear people say a lot about annuities is that they're not very liquid.
Uh-huh.
Like once you put your money in, you're kind of stuck, right?
Well, that's a common concern and it's understandable. But, annuities aren't as inflexible as people might think. Most contracts, they actually do allow for some withdrawals. You might have to pay a penalty if you take the money out too early, but it's not like you're completely locked in forever.
So there is some wiggle room, some flexibility.
Right. And it really depends on the specific contract.
Okay.
So it's important to read the fine print and make sure that you understand those terms before you sign on the dotted line.
Okay, so flexibility is important. Understanding the contract is important. But are there any situations where an annuity just doesn't make sense at all?
Definitely. For example, if someone is in poor health, they have a very short life expectancy, an annuity might not be the best option for them.
Right.
They want to make sure that they're going to live long enough to actually benefit from those guaranteed payments.
Okay, so it might not make sense for everyone. What about people who are really good with money, who have a high risk tolerance and they're comfortable managing their own investments? Would they still benefit from an annuity?
That's a great question, and it really depends. If you're someone who's really savvy and you think you can get better returns by managing your money yourself, you might not need an annuity. You might find it too restrictive.
Okay, so it really all comes back to your individual needs and goals and how comfortable you are with risk.
Exactly.
Okay, all right. Well, let's talk about that decision-making process then.
Okay.
What are like the big questions that people should be asking themselves when they're thinking about getting an annuity?
Well, I think the first question is, what are your goals for retirement?
Right.
Do you want to guarantee a certain level of income? Are you worried about outliving your savings? How much risk are you willing to take?
So it's really about understanding what's important to you.
Yeah, exactly. Once you have a good handle on what you want retirement to look like, then you can start exploring the different annuity options and see which one might be a good fit.
And this is where working with a financial advisor can be really helpful, right?
Absolutely. Absolutely. A financial advisor can really walk you through everything.
Okay.
They can explain how annuities work, they can help you compare different options, and they can make sure that, the annuity that you choose actually fits into your overall financial plan.
Okay, that makes sense. All right. Well, I think we're just about out of time. Any final thoughts before we wrap things up? What are the key takeaways that you want people to remember?
Well, I think the biggest takeaway is that annuities can be a really valuable tool for retirement planning, but they're not a magic solution, you know.
Right.
They work best as part of a diversified strategy. Do your research, understand the different types, and really work with an advisor who can help you make the right decision for you.
And don't be afraid to ask questions, right?
Absolutely. The more you understand about annuities, the better prepared you'll be to make those decisions.
Okay. All right. Well, thank you so much for joining us for this deep dive into the world of
It
annuities.
was my pleasure.
We hope this was helpful for everyone. And remember, knowledge is power, especially when it comes to your money. Thanks for listening.